Let's get right to the floor show. Joining me now, top analyst for big social media names, including Snap, Twitter, Meta, is Evercore's Mark Mahaney, who last night dropped his price target on Snap from $47 down to $36. He's joined by Fidelity Investments' John Gagliardi. Mark, I want to start with you. You know, a lot is being made of the fact that just 4 weeks ago, Snap CEO Evan Spiegel and company were very optimistic, and now everything's shifted. Clearly, you, everybody else, taken by surprise here, but talk to me about how and whether they could have seen this coming.
Well, let me step back a little bit. If I think about what we've heard from technology stocks, kind of year to date, it's been cost inflation. We've yet to hear really the rumblings of demand recession. And we started to possibly hear that from some of the retailers last week. And that's what Snap signaled last night, which is that, and they gave relatively cautious guidance that they're going to come in below the low end of what we thought was cautious guidance. So it looks to us like there's a macro read here for all internet ad names, especially those with exposure to brand advertising, especially those with exposure to Europe, that there's been a bit of a cliff off here in terms of advertiser demand. We're looking for more hard data points. But until proven otherwise, I think that macro read from Snap is probably a decent one. They do $6-5 billion in ad revenue a year, so it's not tiny. So if they're seeing it, chances are other ones to more or less degree. But here's the first real sign we've seen of an advertising recession kicking in.
Okay, but Mark, we're distilling from all of this that, and you've cut your revenue forecast by about 5%. You still have your outperform on it, but you're distilling from Snap. And quite frankly, we could have looked last week and seen Walmart, Target, and then, of course, today, Abercrombie & Fitch, which is down 30% right now. You could have distilled that whatever the Fed has done so far, not working, right? And so this leads me to John Gagliardi. John, tell me, who's the next Snap, the one stock that comes out and then drags the rest of the sector down?
Oh, I wish I knew. I honestly do not. I can tell you that the sectors are shifting, and this is normal sector rotation. We saw the sell-off in tech. It started with the least profitable tech, and it's winded its way into profitable tech. And now it's moving along into communication services across the board. And the logical place that you'd see the business cycle go to is industrials, materials, and energy, but enter the Fed. The Fed is changing the whole game, and now we have to think of them as they're the big seller in town, and they are the person really between reverse repos and selling bonds and raising interest rates. They're really controlling how this goes. And do we get that soft landing? Well,
we got the 10-year yield at a 1-month low, right? The last time we saw these levels, last I checked, 2.78, 2.77. Right now we're at 2.76. Clearly a bit of a flight to quality. But let's get back to this tech story, Mark, and the fact that Snap is a company that, I mean, let's face it, perhaps you and I and maybe John aren't exactly their key demo, but for it to be such a shock means that it's more the message that they had sent. So when we start to see the second quarter numbers that are coming out, or at least starting to, dribble in when we begin to have that opportunity to see how they will do, who are you most worried about of the stocks that you cover?
Well, I would look at ad names with exposure to brand advertising and to Europe. And in my mind, that would be names like Twitter would be at the top of that list. Their advantage is they have a bid. Facebook would have exposure there. Probably the last internet advertising, I say global advertising number that would be at risk would be Google. But just keep in mind, during the COVID crunch and during the 07, 08, 09 financial crisis, Google was impacted too. So even the safest of internet ad models, which is search, that can be negatively impacted. But I also throw out 3 hedges here. It's possible that Snap is seeing an impact from TikTok. It's possible that you're starting to see ad dollars shift back to Facebook. They shifted away from Facebook last year. They could be shifting back this year. And it's possible that Apple is enforcing more privacy screens. So it's possible that those 3 things are becoming more Snap specific than sector-wide specific. So that's a little bit of a hedge here. But I think the right read for now, until proven otherwise, is that we're seeing a macro slowdown in ad spend.
Well, if you really look at it, John, this is what the Fed kind of wanted. They wanted to cool down a sizzling economy. They may not get their dream of a soft landing. But as we continue to look at exactly what they plan to do in June and July, you now start to hear Raphael Bostic, the Atlanta Fed president, saying, well, be really careful. Don't be reckless. Don't be reckless. I think that the Fed looks at the stock market a bit too much and that they may start to wobble. He may be the first that's really starting to wobble to say, well, maybe we need to back up. Is that a mistake? Because I can tell you, I'm not seeing anything get less expensive around here.
We have to look for the green shoots. It's springtime. We should be looking for the things that do well in quantitative tightening. And those sectors should be banking, energy, and consumer durables. And I think the move that we saw yesterday across the board in financials, to me, that was the first glimmer of hope I've seen in a long time.
Yeah, well, we'll be watching all of it and more. And again, the markets are not disappointing with volatility, at least. We do have the VIX up about 4% off the highs of the session. So a little bit of the tightness coming out of the markets. John Gagliardi, Mark Mahaney, always a pleasure to have you both. Thank you so much.
Thank you, Liz.